Hi, everybody. This is Josh Jelinski, the financial quarterback, and we have a special update on tax policy. And could index funds be worse than Marxism? Interesting article by the Wealth Advisor. And Dogecoin is minting crypto millionaires. Joke or jackpot? But first, let's talk about estate planning advisory for the 99.5% Act. Senators Bernie Sanders of Vermont and Sheldon Whitehouse of Rhode Island introduced now this is the name of the bill, for the 99.5% Act. I would call this bill the how to make the 99.5 worse off than before. So always realize whenever you have a bill, take the name and do the exact opposite of the bill. It almost entirely has an unintended consequence. Now, maybe Sheldon Whitehouse is a great man and Senator Bernie Sanders is a nice, cuddly, mittened man. You know, remember the inauguration where he had the mittens and the meme? But let's break down this bill, and I'm going to break down how the average person who wants to get ahead may get hurt by this bill. I don't want to get political here. I just want to break down the aspects of the bill. The chart, and this is from the wealthadvisor.com. So basically, there are proposed changes to the U.S. transfer tax regime by increasing estate taxes. So basically, if you want to leave a family farm, that hurts you. Gift taxes, if you want to gift money that you've already paid taxes on. Generation skipping transfer taxes, and vitiating, what a big word, the effectiveness of certain wealth transfer planning techniques. So first I'll tell you the current exemption. So if you have a lot of money and you want to gift it to the next generation, you can give 11.7 million without any gift tax. The proposed exemption would be $1 million, not indexed for inflation. Now, back in the day, it was 10 million, but due to inflation, it's 11.7 million. So if you leave anything above $1 million, so Ernesto, you leave $1 million to your future children, and the government, under this new scheme, would get between 45% and 65% when you die. Why? Because as Bill Maher once said, it's much easier to tax dead people. I love that quote. Do you remember that quote?
I do. Bill Maher's on a roll lately with his concern for the middle class. I love it.
Now, this was a long time ago that I heard it. I don't know if he's still purporting. So if you leave $1 million, 450 grand could go in this new gift tax regime. How are you going to pass family stock? Disney stock you bought for years? Here's the thing. Don't we want the 99.5% to become the 0.5? I always said a big mistake in the way Donald Trump, former President Trump, proposed everything was when he's rich, whatever. You know, if I was to run for office, you know what I would say? I want to make everybody rich. I want to build an America where you can be rich too. Wouldn't that be a good slogan? You know, so instead of make America great again, make America rich again, you know? So, but I always wonder, why are we trying to target the creative, the productive of society? There's been numerous studies shown that no matter what the tax rate is, whether it's 90%, 60%, or 25%. The government gets usually 18 to 25% of GDP. They never usually get more than that because what happens is people are rich. They don't need to work, so they stop working. They say, you know what? Jack Nicklaus used to stop playing golf, I think. Ronald Reagan used to stop making movies. When he made enough, boom. That's what a progressive tax does. It forces the average person to be less productive. So then that's the gift tax. Then the GST tax. Now here's my theory. And hold on for the end of the video because I will announce my theory of why I think the GST tax, estate tax, why this 99.5% act is being announced now. Why is it being announced now? Like, why do they care? Is this really going to happen? Probably not going to happen. But why announce it now? Because it's like, I'll reveal it later. What would be your, why do you think they're announcing it? Why are they announcing now? Well, we'll see. The GST tax stands for Generation Skipping Tax, for those wealthy people who have trusts and dynasties. And let's tax them. The GST tax, so if you gift over $1 million, you could have, the lowest tax would be 45%. The GST tax would be a flat rate equal to the maximum estate tax rate, which would be 65%. Currently, that's 40%. So let's say you're worth $30 million and you're single. Think about this. You're single, you amassed a $30 million fortune. You have $11.7 million that goes tax-free right now, estate tax-free. It was already taxed money. So you're not gaming the system. You've already paid income tax on that money. The next $18.3 million would be subject to a 40% tax. You've already paid income tax on that money. So that's the current rate. So it's not like these super rich people have huge gimmies. If we're trying to raise revenue, I think the answer to raising revenue is to have some type of, 1% tax. Like literally it's like a 1% transaction tax when these large billion-dollar estates give, $1 billion to charity for the purpose of evading taxes legally. That's really what I think is the problem here, because these super rich people, they just create these, billion-dollar charitable trusts, which is great though. But, if we're trying to get broadening the tax code, this isn't going to happen. Then you have the estate tax. Current estate tax is above 11.7 million, and that's now up to 40%. That's going to go to up to 65%. So there's gift taxes, there's GST taxes, and there's estate taxes. Reminds me of the Beatles song. Tax it when you sleep, tax it when you die, tax it when you work. Mind you, whoever says we're not taxed enough has really never owned a business, or they've never made a significant amount of money, or maybe they're so rich they're just guilty that they're rich, which could be that could be a problem. So other proposed changes to this new 99.5% Act are annual exclusion gifts. Annual exclusion gifts would no longer be unlimited. This is a direct screw job on the middle class granny who writes, your grandmother ever wrote you a check? Oh, I'm going to give you 15 grand. Well, that's the allowance. That is going to be done. A donor could not give more than twice the annual exclusion amount, which is $30,000, if the gift is of an asset that cannot be immediately liquidated by the recipient, such as gifts in trust or gifts of entity interests. Withdrawals or put rights will be disregarded for this purpose. So a donor under this bill could not give more than twice $15,000 if the gift is of an asset that cannot be immediately liquidated by a recipient. Because you could say, well, it's not exactly granny, but it's who it's going to end up hurting, I think. Grantor Trust, assets that are transferred by a decedent to a grantor trust after the enactment date would generally no longer avoid estate tax. This is big. That means if they pass this bill, let's say this summer, and you did things to plan, let's say today, they are going to tell you if you didn't do the planning, nada. You don't get luck. So that means all these rich people are going to go do these trusts before this bill's enacted. So it's going to not even fulfill the purpose it was trying to intend, but it'll hurt people after who were poor or more middle class, who maybe got wealth over time, maybe from a family farm, maybe from a small business, and they just didn't have access to the planning or the planners. So there's changes to grantor trusts. A grantor trust created and funded prior to enactment date would generally be exempt from these provisions to the extent no additional contributions were made after the enactment date. That's huge, people. So if you have a grantor trust So if you want to leave, I don't know, $10 million to your family, usually you pop it in a trust, it could grow, estate tax free. You still paid income tax on the money, mind you. Now, you have to do it like before they enact this. Now, I said I would reveal why they're doing this. And I'll reveal that in a little bit. But first, a couple more specifics of the bill. GRATs, those are called Grantor Retained Annuity Trusts. So if you are wealthier, you go to estate planning attorneys, and they do things to minimize gift tax, GST tax, and estate tax. They don't avoid them, by the way. So if you're worth $100 million, and this is also a lie that they avoid taxes, you might avoid estate tax on the first 22 million. But money from 22 to 100 million, that's 80 million. You're paying like 32 million in taxes. Just gift taxes. And generally these were already tax monies anyway, because you made the income, you saved it, whatever. I'm telling you, this is really designed to get this new money out of Silicon Valley that's hidden in their stocks. But I don't think they're going to get revenue this way. I would just say a Silicon Valley tax, But I bet you they would lobby. And I bet you that'll never pass. Because this is going to hurt the family farm in Wisconsin, $10 million dairy farmer, whatever, who came from nothing and built something nice. It's not going to hurt, the Zuckerbergs of the world, because they have stock that goes into their trusts. It avoids a lot of this. So really, it's going to get the people in that reacher category. But I'll reveal why I really think they're announcing this later, because I think this is the point. The 99.5% Act, it's for the 99.5 who wants to stay 99.5. I don't know about you. I want to become the 0.5. Don't you, Ernesto? I mean, where was that, taught? Is this what we're teaching in schools? We want to be, I want to be the 99. Even if you are the 99, you want to be the one. You want to be, and by the way, if you're in the US, you're part of the one anyway. So global perspective, if you have enough money for a Walmart big screen TV, you're very rich by world standards. And usually when you ever see these soak the rich policies, they end very bad. You saw that in France, like Gerard Depardieu was moving out of France when they had these 90% taxes. And a lot of productive people leave. We're seeing that in New York City. People are leaving New York City for Florida and Texas and all these other places where they're taxed less. So GST exempt trusts. For a trust distribution to qualify for GST exemption, the trust could no longer have a term of more than 50 years. Existing GST trusts lasting more than 50 years would lose their GST exempt status 50 years after enactment. That's major. Because what that says is, Ernesto, it was good enough for the Rockefellers. They could build their dynasty trusts, but not you. That's a shame to me. Because all these families, these very wealthy families you hear about, that do a lot of charity, right? The Rockefellers, the Gateses, all these people. We can't do that anymore if the 99.5% Act passes. So right now you could do a dynasty trust in Nevada. It lasts for 365 years. So if you pop money in, you get 365 years of tax-free growth, estate tax-free. This is all about stopping that. Here's the thing. Why not allow this, but do some type of 1% whatever tax? You'll get more, because then all these rich people, they'll move to, you'll see all of a sudden Jeff Bezos moves to New Zealand, where he's not taxed as much. Or, you saw that with Eduardo Saverin of Facebook. The guy moved to South America to avoid all of these taxes on his Facebook stock. So valuations would change. The availability of marketability and minority discounts for appraisals of interest held in entities would be limited. That's massive because a lot of highfalutin estate planners do that. Basis step up. The act would confirm that a step up in basis is not available to assets held in a grantor trust unless those assets are included in the grantor's estate. That's big. Now that might be actually okay if they're trying to tax Facebook or Amazon, but realize it's not going to hurt those people. A separate bill known as the Sensible Taxation and Equity Promotion was also recently enacted. Here's the thing, I can't go on anymore. It's just too depressing. My whole life I've been taught that if you work hard and save, you can pass something down to your kids and grandkids. And they're trying to wipe that all out. I don't know about you. I find that un-American. But it's all designed, I've been talking about this, that they're going to raise taxes. But here's the thing. Why don't you just have a flat tax on these people? People doing all these weird exotic trusts pay 10% a year on their trust growth, or 15% a year, 20% a year. Why do we have to do all this Swiss cheese? You know why? Because special interests then lobby, and then people find holes and loopholes around them. But anyway, so what do you do? And why is this in the bill? Here's why I think this is in the bill. It's like the Overton window. They have something so bad with the good name for the 99.5% Act. And then what ends up happening? Oh, here is the Biden Tax Act. And that's actually moderate compared to that. It probably is, And so that way, whatever we end up getting as a result of Congress and the president kind of hashing out a deal, we accept gleefully because we only got taxed a little bit more. But there are some significant issues with the Biden tax proposal that people do not realize, and I will tell you what they are. So we're going to go from the Sheldon Whitehouse Act with Bernie Sanders, for the 99.5% Act, to never become a part of the 0.5% Act. That should be what that bill's called. If you ever want to be higher end, sorry. The priorities, this is from taxfoundation.com.org. The American Jobs Plan would fund infrastructure investments and increased spending on other priorities by increasing the tax burden on domestic and foreign earnings of corporations. It would raise the corporate income tax rate from 21 to 28%. If that's all we get, I would take that. If that was all we could do, I don't like it. But I think we're going to have a deal cut and it'll be 25. And they'll say, Joe Manchin. Everybody loves Joe Manchin. So we'll get a 25% tax rate due to that. Then raise the tax on the global intangible low tax income to 21%. Calculate it on a country by country basis and eliminate the exemption of a 10% return on tangible investment abroad. That's one of these, overseas things. Impose a 15% minimum income tax on corporate book income, which will be levied on a financial firm's profits instead of taxable income for firms with revenues of over 100 million. That's major. That would take on a lot of these companies that don't show a lot of income, like a Facebook or Facebook, I think should, but like an Amazon didn't show income for years, or Tesla. And they're getting tax incentives and government contracts. Folks, by the way, there is some reform of the tax code that I think needs to happen. And this may be the one thing that you could get me to agree on theoretically. But I just don't know why we don't. Or you could have a sales tax. a national sales tax and get rid of the income tax. But this aspect of the bill would really be bad for the big companies of the world. Now, you might say, well, who cares? They can pay it. Well, I know a lot of people got very rich by being employees at Google, Facebook, Amazon, Netflix, or working for them. They have a lot of fat. They can afford to pay many employees great, healthy, livable wages. We all want livable wages. And they do that because there's a lot of fat on the bone. So I think the better way to do this would just be to have a flat tax, not to have some special privilege, or because they get to expense certain things because they're fueling the economy, or you just have a national sales tax for those companies. So when they buy a good or service for their business, they might pay a 10% sales tax or something. Or we just do away with the income tax. We have a fair tax. And then it would repeal the foreign-derived intangible income deduction. It would provide a tax credit for certain onshoring activity and deny expense deduction on jobs that were offshored. Here's the thing to me. That actually makes sense. Why don't they just have two tax codes? One for if your business is overseas, you get taxed more. If you bring everybody back to the U.S., then we're taxed at 21 or 15. And then, like Apple, they just built a $1 billion plant. They announced $1 billion plant in North Carolina. There's going to be so many jobs there in the Research Triangle. So when we treat our companies best, they generally will come back. So I would do something like that, like almost a two-tiered tax system. If you want to be domiciled in Ireland for the 13% tax that they have on corporations, well, you have to pay 28% tax and you get to, So it's interesting. I think all of these things are very confusing. So then people hire tax attorneys and they find ways around it. I think a flat tax is the way to go, but I'm nobody. I'm just Josh Jelinski, the financial quarterback. So the American Families Plan would fund $1.8 trillion of increased spending on educational and child care related policies by increasing the tax burden on high-income individuals and pass-through businesses so that you can go to community college. I know of no one who aspires, no offense. I don't want to say this. Community college is great. And if you got into community college, good for you. It's a great necessary program. But wasn't the whole purpose of community college so it's subsidized by our taxes so you can go for cheap? You go for a couple grand. Like, why does the whole amount of community college need to be subsidized? I don't see the need for that. But if it is, then it becomes less valuable. It almost becomes like 13th grade and 14th grade. You're not really distinguishing anything. In fact, Tesla has now said, Elon Musk has come out and said, we don't even want college graduates because they don't really know anything. So we want certain attributes of people. You're going to see that with more and more tech companies as they realize like a college degree is just going to become like another high school diploma. So if everybody has a college degree, what is the value of it? Like, oh, I've gone to school to be an idiot. I don't understand. It's the same thing like universal pre-K. That everybody, we're spending all this money on universal pre-K. Generally, I find that only politicians want that. You talk to most parents, they actually would want a program where they could stay at home for the first 5 years of their kids' upbringing and be a part of their life. So maybe a tax credit for people having babies. That's significant. That would encourage people to stay at home. People don't want to slave at two jobs so that the government could take care of their kid from age 2 to 20. I don't know about you. I want to be at home with my kids. And I work a lot. So I totally get it. So, I understand the universal pre-K if like you're single mom and you're struggling to make ends meet. I totally get that. But I think there should be some type of, rather than universal pre-K, well, let's build a culture, right? Where if you're a stay-at-home mom or if you're a single mom who works and you want to take 5 years off for your kids, maybe we do some things to encourage that if they want that. So it's all about women's rights here on the Financial Quarterback radio broadcast. But universal pre-K, then what do you tell? Okay, if you're an employer, right, and you have an employee and they're saying, well, I gotta be at home to take care of my kid. They go, nope, universal pre-K, your kid's 3. We'll give you 0 through 2, and you gotta come back and tough tookies. Anyway. So what other tax rates would go up? They would raise the top marginal tax rate on individuals to 39.6%. So that's another tax increase. Apply ordinary income tax rates, including the proposed 39.6% rate, to capital gains. Whoa, that's a big one. On individuals with more than $1 million in taxable income. 11, again, that's sort of to get the Silicon Valley wealth. Well, why don't you say with more than $100 million in taxable income? It's going to go after small business owners. Then 11, tax unrealized capital gains at death with a $1 million exemption for single filers and a $2 million exemption for joint filers with additional exemptions for certain types of assets. That's to, I guess, stop critics who say, oh, you're going to just tax granny's $15,000 in Disney stock. So they must have been listening to me because I've been saying that. So they added some provision that says, like, if you pass $1 million, you get an exemption. But above $1 million, you got to pay up. Which, again, I think this is designed to get a lot of these people who have stocks. They don't pay a dividend. They don't pay tax. There's other ways to get these people. Have some type of mandatory dividend taxation. That way they're treating their shareholders well. And then they're paying tax of 39.6 on the dividend or something like that. That's how it used to be. But now all these companies don't pay dividends. They're not being compensated to treat shareholders well. Apply a 3.8% net investment income tax on all income above $400,000. So that's 3.8 plus 39.6. Make permanent the 2017 tax laws limitation on pass-through business losses. So if you have a loss, you can't pass through certain things. So let's say you lose $1 million on your business and then you make money. To me, why would you not allow pass-through business losses? Then you want to limit 1031 like-kind exchanges. That's huge. And here's why that will. So think of it, you own $100 million real estate in Manhattan or whatever, wherever you own. You'll just stay. You'll become like the landed aristocracy. You'll never sell because you're going to be taxed 39.6. Thereby, there will be no homes on the market. Thereby, the income inequality that we all worry about will be driven up because regular people, this is already kind of happening, by the way. And if you limit 1031 exchanges, generally a lot of wealthy people will go from one real estate to the other doing a 1031 exchange and they get deferred capital gains. But most people, that's why I like a flat tax. Most people would not sell their real estate to avoid a 10% tax or 15% tax or 20%. I know plenty of wealthy real estate people. They will not sell if there's a 39.6% tax. They'll just hold it. They'll live off the rents. They'll charge their people more. So somebody who can't afford to own is going to have to pay the landlord more. They'll find a way around this. Then tax carried interest as ordinary income. That might actually be good. That's the carried interest loophole that a lot of people take that we've talked about for years getting rid of, and nobody's ever gotten rid of it. And then increase individual tax enforcement. They're going to give the IRS up to $80 billion. And here's the thing. They're probably going to go after low-lying fruit. They're not going to go, if you're a billionaire, right? You're hiring a whole fleet of tax attorneys. They're going to go after the small business who might be sloppy. So they're going to extend the child tax credit which is a good thing, to $3,600 for children under 6 and $3,000 for children age 6 through 17. I think that's if you only make certain amounts. So like for me, I have 6 children. I don't think I get any of these benefits. I'm actually, the greatest stimulus to the economy is having babies. And I don't even think I get anything from it. Make permanent full refundability of the child tax credit. Make permanent the near tripling of the earned income tax credit for workers without qualifying children. Make permanent the expanded child and dependent care tax credit so you can get money back for child care expenses of up to $4,000 for one child or $8,000 for 2 or more child. That's great, but did they give that to my wife who stays at home with our kids? No, they're not giving that. So this discriminates against women's rights who want to stay at home. But anyway, so we would have dramatic tax changes here, folks. What do you think? Give us a call, 888-988-JOSH, if you want help navigating through the incredible, there is just a blistering speed of tax laws coming down the pike. You're going to have to keep it here. I will tell you, I think all of these things are good for my business because it means, wealthier people will want to take action. They will want to finally, so many times people, they got a lot of money. I don't need to do anything. I'm going to go on my yacht. I'm going to go on my boat. Now I get like people with significant wealth, billionaires, multi-millionaires. Somebody's go, well, Josh, I think I got to sell my properties because the capital gains rates are changing. What do I do? Well, you call us 888-988-JOSH and we'll help you. Whether you have, 50,000 or 50 million, we're here for you.
The preceding program was sponsored by the Jelensky Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelensky or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jelensky.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelensky and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.